What if a few smart investments today could transform your wealth forever? Long-term ETFs are the secret weapon of savvy investors. ETFs, or exchange-traded funds, allow you to buy, hold, and have jaw-dropping changes in your wealth. But the real question is finding the right ETFs to invest your money and time. In this video, we are going to reveal the top 3 ETFs that you can buy now for long-term wealth and stay ahead of the market. So, if you want to find ETFs that have been outperforming themselves over the years, stick around till the end. Let's get the basics cleared first. ETFs, or exchange-traded funds, are basically a collection of investments. You can buy this collection, hold it, and then sell it when the returns are high. We've talked about the stock exchange here, and ETF is similar to that. In fact, the stock also comes under an ETF. Apart from that, ETFs can also include bonds, currencies, and even commodities. Now, finding the best ETF requires you to focus on a few things. You have to consider the management costs, the commission fees, the feasibility of buying and selling that ETF, and the presence of that ETF in your existing portfolio. But don't worry, we've already thought about all of that for you. And after considering all of the factors and the different ETFs present in the market, we have finally got the top 3 ETFs for you to buy. Number 3. Invesco QQQ Trust. The Invesco QQQ Trust is one of the most popular ETFs in the market. It tracks the NASDAQ 100 index. This provides exposure to the 100 largest non-financial companies listed on the NASDAQ. If your focus is on high-growth and tech-heavy companies that dominate the global market, this is an excellent option for you. Now, this is basically a tech-focused ETF. The fund's holdings are in some of the most influential and high-performing companies in the world. Companies like Apple, Microsoft, Tesla, Alphabet, and Amazon are currently at the forefront of technological innovation. From cloud computing to artificial intelligence, these firms have got it all. You can also get a part in these companies because the QQQ ETF has holdings in all of these. With a 1-year return of 32.75% and a 10-year return of 17.96%, the ETF has beaten the S&P 500 7 out of the last 10 years. Driven by the dominance of large tech companies, the ETF has an expense ratio of 0.20%, which is relatively low for a sector-focused ETF. Considering the massive returns of the QQQ ETF, this expense ratio is very low. If you decide to invest in this one, you'll be getting exposure to some of the most powerful companies in the tech industry with an expense ratio of just 0.20%. That honestly sounds like a treat. With exposure to software, hardware, cloud computing, cybersecurity, and even semiconductors, the tech industry has been the primary driver of global economic growth. The technological innovations in literally every industry, from healthcare to finance to textile to service, technological innovations have been leading everything. And QQQ's holdings are positioned to continue to lead in terms of market share and revenue generation. And the best part is that you will be getting significant exposure without taking the risk of placing all your eggs in one basket. Number 2. Technology Select Sector SPDR Fund, or XLK. The Technology Select Sector SPDR Fund, or XLK, is another great option if you are inclined towards the technology sector. This ETF has been tracking companies that fall under the information technology category in the Global Industry Classification Standard, including all those in internet software, IT consulting services, and semiconductor equipment. This ETF also provides exposure to all areas of the tech sector. It also has holdings in internet-based companies like Microsoft and Apple, as well as in IT services providers. This one also includes companies like NVIDIA and tech hardware manufacturers. So basically, with the XLK ETF, you can comprehensively invest in the entire tech market, including IT service companies and equipment manufacturers, without having to pick individual stocks. In terms of returns, This ETF has beaten all other ETFs. With a 1-year return of 30.75% and a 10-year return of 33.13%, this ETF has had significantly strong returns. And the expense ratio is as low as 0.09%. That makes it one of the most cost-effective tech ETFs available right now. So now you're not just getting high returns, but you can also capture the benefits of the tech sector without being weighed down by the high management fees. I don't think it can get any better than that. You can have exposure to the world's largest and most profitable companies such as Apple and Microsoft at such a low expense ratio. And if we're talking about growth, then these companies benefit from strong consumer demand, and the way they have been consistent, it will not go down anytime soon. With the current mobile technology and digital transformation trends, these companies can heavily benefit XLK. However, all these ETFs come with some risks. We know that tech stocks are sensitive to changes in the market, but we are considering the history of these ETFs and their holding, and with the data available, these ETFs are as safe as it gets. Number 1. iShares US Medical Devices ETF, or IHI. If you are looking for an opportunity to invest your capital in the growing medical technology sector, then this ETF is perfect for you. The fund tracks the Dow Jones US Select Medical Equipment Index. The index basically measured the performance of the medical equipment sector in the US equity market and included medical equipment companies. So, we are talking about all manufacturers and distributors of medical devices like MRI scanners, prosthetics, pacemakers, X-ray machines, and every other non-disposable medical device. However, the fund is not diversified, but that might be okay, because this ETF has consistently performed well over the years. With a 1-year return of 19.12% and a 10-year return of 14.1%, the ETF has been straddling growth in the medical device sector. It is understandable because, with the advancement in technology and medicine, the world has needed more medical devices and treatments, which is why the sector has grown, and that's why the ETF has also grown. This also means that the ETF is nowhere near declining. Because the medical sector continues to grow, we will need more medical devices with time. The IHI ETF is composed of a few of the biggest companies in the medical device market. It includes firms like Medtronic, Johnson & Johnson, Stryker, and Thermo Fisher Scientific. Almost all of us have heard of these companies because of their innovations in healthcare and their role in transforming medical treatment. With an expense ratio of 0.40%, this ETF is relatively cost-effective. Although the expense ratio is slightly higher than that of other ETFs on the market, the historic growth of the ETF has made up for that, which is why, despite having a relatively higher expense ratio, it continues to attract investors because of how it offers substantial wealth growth and exposure to the healthcare industry. With the global focus on improving healthcare access and, unfortunately, because of rising chronic illnesses, medical devices are increasingly becoming essential. So growth is a given in this ETF. If you choose to invest in any of these 3 ETFs, you can grow your wealth with little to no intervention. Yes, the market fluctuates, but considering the past trends of these ETFs, the market has always trended upward for these. These were our top picks for your ETF investment. Are you inclined toward any one of these? Let us know in the comments. If you like this video, share it with your friends. Don't forget to hit that subscribe button so you stay in the loop and do not miss out on any of our videos. Subscribe now. See you in the next video.